Hi, I'm Wade McElwain, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we're asking whether markets have hit peak greed as we approach the end of 2020. Markets are said to be driven by spirit animals, but in reality, these are just the distillation of human emotions and behavior. As a species, we're notorious for crowding. That's not forcing ourselves into confined spaces, but instead acting collectively rather than as individuals. These type of behavior tends to show itself at sporting events and concerts, but also in the financial markets. And when it does, we need to be aware as it can have some far-reaching consequences. In the markets, the level of greed is not so much about financial gluttony, but more about the level of risk that investors are prepared to take to achieve their desired return. That level of acceptable risk changes over time. For instance, at the beginning of a bull market, investors typically buy large cap blue chip stocks. But as the price of these giants move up to become fully valued, investors need to look elsewhere to make their money, and so they look at lesser known and potentially riskier investments like mid and small caps. Now, there's nothing wrong with it if investors adjust their expectations and perceptions of risk as they trade down the ladder, so to speak. However, they don't often do that. Instead, expect those smaller and mid-cap names to behave just like their large-cap peers. Initially, they may do so, but in adversity, for instance, in a market correction, the true characteristics of those smaller, riskier stocks can be revealed. Typically, these stocks have much lower liquidity or volumes traded and much wider bid-offer spreads. And whilst you can easily move in or out of blue-chip equities, cutting a position in riskier stock can be an expensive exercise if it's possible at all. And that can be made even harder if the crowd of other traders has similar positions to you. When we talk about peak greed, we're talking about bubble behavior, in which traders and investors become blinkered, only trust their viewpoint and fall victim to traits such as anchoring and confirmation bias. In essence, they believe that they are right, and anyone with an alternative viewpoint or position is wrong. The dot-com boom and bust of the early noughties is a classic example of the bubble behavior, but the patterns can be found as far back as 17th century Amsterdam, when a single tulip bulb traded for more than the price of a townhouse. So, what tools and indicators can we use to spot excessive or peak greed? There are many, and we don't have to look far to find some that are readily accessible. A good place to start is CNN's Fear and Greed Index, which combines 7 underlying indicators and converts those into an index that ranges between 0 and 100. The indicator currently stands at 87 and is in extreme greed territory, though it has been as high as 91 in the last week. What's more, the indicator has rallied from a reading of just 30 over the last month. Readings of 30 are in the category of extreme fear, so the gauge has literally moved from one extreme to the other. Another way we can try to decide if greed has the upper hand is to look at the way that investors are positioned. We obviously can't see exactly what other people are holding, but what we can do is look at what contrarian investors are doing. These are professional investors who make a living out of trading against the grain. To do this, we can look at the amount of short interest there is among the S&P 500 stocks, in this case, as a percentage of their market cap. We can see that the short interest in the largest U.S. equities is the lowest level it's been for 16 years, and far lower than it was in the aftermath of the global financial crisis of 2008. Of course, if few or any traders are short of the market, then they must be long of it, and that is clearly suggestive of bubble behavior or a one-way market. That doesn't mean that equity markets can't go higher from here, because they can. However, with the Nasdaq up 42.6% year to date, it's tempting to think we may have seen the best of the market for now. They say the best time to leave a party is when it's at its height, so it may well pay to be on the lookout for that crescendo from here on in. That's all the time we have for this week. Remember, make sure you do your own due diligence before making any investment decisions.